Hello and welcome to MacroLens. Since 1990, the US stock market has barely ever seen the Shiller CAPE ratio for S&P 500 fall below 20. But what if I told you that a recession today could change that? And it might take a 50 to 70% crash in the stock prices just to bring valuations back to the historical norms. This is a graph of S&P 500 CAPE ratio that illustrates what we're going to talk about today. So a quick reminder, a CAPE is a price divided by 10-year average of earnings, inflation adjusted. So it shows you the best way to see if a stock market is in some kind of overvaluation or bubble. And in this graph, you can see that for most of the time, the CAPE has been between 10 and 20. It is in the recent years, in 1990s, that something strange happened and CAPE went above 20 and stayed there. It was 15, dropped to 15 in 2008 just for a short period of time and then went back above 20 again. So why is this? So number one reason is that 401k in USA, it's a system that introduced steady inflow of money into the stock market. So Americans auto-invest every paycheck. So it's a lot of money. Then number two is corporate buybacks that exploded in the 1990s. And this is trillions in demand. And as number three, it's foreign investors that see US stock market as safest place for capital. Together, these three things create a new floor for valuations ever since 1990s. But this is changing. Demographics are changing. Boomers are retiring. They aren't adding money anymore. They are actually now withdrawing more and more. So let's look at the numbers. Retirees take out about 0.5 trillion every year now because there are more and more old people, more and more boomers are retiring. And workers add about 0.4 trillion every year. So now retirees are actually taking out more than workers are adding. And the only reason that the stocks are holding up are the buybacks and of course foreign capital. So what happens if we get a recession? Well, contributions from jobs fall because of the job losses. So contributions from 401ks goes down. Buybacks, they collapse because in 2008, what happened was that the buybacks fell down by 70%. So all of a sudden, companies did not want to buy their own stocks anymore. Foreign investors, they start buying, they go to cash and treasuries. So bonds instead go up in value while stocks goes down. And retirees, they withdraw more and more because they see that their retirement money is disappearing. So they panic and start taking out as much as they can. And all of this just flips the picture in totally negative direction. So historically, in 2000 to 2002, the CAPE collapsed from 45 to 22. So you can see here that in 2000, the CAPE actually reached 45, and this is historical high. It had never been at 45. And in 1929, it actually went above 40, a bit over 40, but not 45. And in 2001, it collapsed to 22. And then in 2008, 2009 recession, it fell from 27 to 13. And this is the first time it went under 20 since 1990. So you can see here that this drop here to 13, it actually brought it back to historical norms. So this was normal. But it was short-lived. It went up above 20 again into overvaluations. should today's risk be considered as higher risk? So number one, of course, the CAPE is extremely high at 38. It is not as high as in 2000, but if you look at the number two here, earnings are still inflated by COVID stimulus. So during the COVID, we had a lot of money coming in, trillions in government transfers, ultra low interest rates, which made company earnings even larger, and buybacks that boosted earnings per share artificially. So if we do get a recession now, earnings, they will not just slow, they will actually just collapse. So here is one example. If you, for example, if earnings drop by 20%, but CAPE stays high, this means that you will get even bigger price drop to normalize the price. So earnings and CAPE, they are related, because as earnings go down, for CAPE to go down, price needs to collapse even more. So how big crash can we get if we do get a recession, or when we get a recession? Eventually a recession will come. So for the CAPE to return to 20 from today's 38, if we assume that earnings don't change, so the companies earn just as much during recession as before, then we need a drop of 47% in prices for CAPE to come down to normal 20. Now, if earnings drop by 20%, the price drop needs to be 60% for CAPE to come down to 20. And if earnings fall by 30%, the prices need to drop by 65% or more for CAPE to come down to 20. So, in other words, a recession could require 2008 style crash just to get back to normal. But of course, this assumes that normal is 20, but actually normal is 15. So to get back to 15, the crash would need to be astronomical. The stock market would need to go down by 70%, because I am of course assuming that earnings will also go down, and they will if you do get a recession. That's for sure. So will CAPE ever fall down below 20 again? So if you look at the history as a guide, the answer, of course, is yes. All you need to do is look at this graph here and realize that eventually it will have to go down below 20. But it may take a recession to break this flow of money from 401k, buybacks, and global capital. And when this happens, the adjustments will be brutal. So the question isn't if valuations will come back down. The question is how painful the path will be to get there. Thank you. And of course, like and subscribe, because I will be going deeper into these subjects in the future.